happy Friday. Welcome to Money Talks. I'm your host, Bill Barhydt, founder and CEO at Abra. So look, before we get to the show, I want to send a very clear message, solidarity and support to the Abra Ukraine team. We're in pretty regular touch with the team, and also to all the people in the Ukraine. A good portion of our team is based there, and watching what's happening over there is absolutely horrifying. We hope everyone is able to stay safe. We're certainly doing whatever we can to help. Obviously, it's not much right now, but we certainly are in regular contact with all of our employees and staff over there. The well-being and security of everyone is our top priority. We hope for a quick and peaceful end to the violence. And of course, please do whatever you can to stay safe. So that having been said, we are fully operational at Abra. Funds are safe, yield is coming in, trades and swaps are getting executed, and we're still seeing lots of new deposits. Abra remains the single safest place to earn yield if you hold crypto or want to hold crypto. Of course, we have our CPRX token, which is a great way to earn incremental rewards on top of your already great returns. And honestly, at these crazy low CPRX prices, given the market turmoil, you're getting way more CPRX right now than you did just a few weeks ago. And of course, I'm personally super excited about where that project's going. Next week, I want to do a show mostly dedicated to C-Perks, Abra Perks, the latest news there. We'll get some other folks from Abra in, and we're going to talk about it in detail. Okay. All right. Just keep in mind our trade function. It's the best place in the business, with even more cryptocurrencies and advanced trading features being added in the coming weeks. Our borrow function is the only service in the world that lets you borrow against your Bitcoin or Ethereum for 0% interest. Where are you going to get a better deal than that? Okay, so this week we're going to get into the big macro picture, just like I promised you last week. Of course, that was before even this crazy Russian invasion of Ukraine. Then we're going to talk about proof of stake, soon to be the way the Ethereum network processes transactions. Of course, Natalie Brunell, Abra's Bitcoin analyst, is here with an in-depth look at Bitcoin. And of course, we'll get into the crypto headlines of the week and hopefully have some time at the end to do a few questions. All right, so I'm going to reverse things a little bit, and I want to talk about markets and macro to kick things off today, as opposed to putting it at the end, because honestly, a couple of things. One, it's what everybody wants to talk about right now. In other words, where is this all going, right, and why? We're going to talk about the bond markets as well. And I'm going to talk about a Fidelity analyst report that I saw on Twitter last week. All right, so let's go to the charts for just a few minutes here and see what they're telling us. So I'm going to start with Bitcoin. Now, first interesting thing to realize is that Bitcoin has recovered all of the losses and more that it incurred after the invasion began. Okay. Now, that's actually a fairly typical scenario, believe it or not. This is a series of charts showing what happens in now these are equity markets indices in aggregated after different wars have begun. You can see Vietnam, Gulf War I, the Iraqi War in 2002, Crimean crisis, et cetera, et cetera. The only exception was the Afghan war after 9/11. And there, the biggest issue was we simply had a huge overhang still from the dot-com era, which obviously brought stocks way down via massive reset. So I'll discount that one a little bit, but it's there, it's data. But look, the bottom line is that, as you'll see when we get into the bond market part of the discussion, things basically look way oversold. Okay. All right. So let's see, where do we want to go first? Let me go back to the charts. I want to show you a couple of things here, right? So as I said, if we, Bitcoin is recovered, if we get a break above this line right here at about 43.5, probably more so than 42.5 here. If we get a clean break above 43.5, I think we're actually entering a new bull market. Okay, that could, I actually thought that might happen in the spring, summer. Now I think it might actually happen in the next couple of weeks. I think the momentum and the idea that the Fed is not going to tighten as much as everyone first thought, which is what I told all of you a few weeks ago, actually told you all pretty much every week, that this is all overblown, will lead to the market screaming higher, in my opinion. Okay, so let's look at Ethereum really quick. And we'll come back to this a little later in the show. But again, Ethereum also completely recovered, looking extremely bullish. I'm going to switch to the daily. This is the 4-hour chart. So on the daily chart, look at that green candle. Okay, so that's a 4.5% move. We were up about 5% as of maybe an hour ago, but we're clearly above 2,700 now, which is, again, well above. Look at the recovery on this candle from the 24th. Which is just nuts, right? I mean, this is the evening from when the invasion started. Ethereum plummeted all the way down to 2,300 and is now almost, 17, 18% higher than the lows from 3 days ago. Okay, so that's a very bullish sign for Ethereum in the short term. Okay, there's no denying that we're in the middle of this pullback. It's got a ways to go to get back above that pullback range. But you got to start somewhere, and right now it looks very, very positive. Okay, so all of this basically tells me that on a longer term, and I always say when in doubt, zoom out, on a longer term time horizon, and if I basically go back all the way to, let's say, last summer, right? I'm going to go all the way back to last summer. What this basically looks like to me from or even last spring, from the beginning of May until now, it basically looks like a big sideways chop. And it's the same for Bitcoin. Here's the Bitcoin version of the chop. All right. And I wouldn't be surprised if we get a few more weeks of this chop. Now, by the way, chop means that Bitcoin could easily recover to 55,000. We're still in the same range, right? So to be clear, chop doesn't mean we stay at 40,000. Right, this is a pretty wide range, which is what you would expect for an asset class with these incredibly strong network effects, which is the next topic. Okay. All right. So post chop, I think we're heading to new highs. Now, the question is, does this chop end at the end of the year, in the spring, in the summer? I'm leaning towards end of year. I think we basically do retest 50,000, which puts us right about here in the coming weeks. I don't know if that's sustainable, but I wouldn't be surprised. As a matter of fact, I'm fully expecting a retest of 50,000, and then we'll see what happens. But my broader thesis is chop for a few weeks and then new highs. Okay. And I don't know if a few weeks means end of year or fall or summer. But again, when we're zooming out, it doesn't matter so much. All right. So I want to segue that into, we talked about, the effect of war on prices. I want to talk a little bit about Bitcoin versus the bond markets. All right. So my friends at Pantera published a fantastic kind of overview of what they think is happening with the bond markets. Now, my take on bond markets is bond markets lead everything. Right. Historically, when you get into these debt cycles that we're in now, and we're in a late stage debt cycle, if you read a lot of Dalio's current writings, he talks about this, and he's very eloquent about how these debt cycles come and go and why, and the wars that inevitably result from ultimately bond markets. Right. The late stage debt cycle basically is another way of saying who's going to get left holding the bag when all these world currencies go to shit and the debt becomes worthless. And right now, China is basically holding our bags because they're basically sitting on a significant portion of our debt. They don't want to buy any more because it's worthless. And, bond prices are soon going to reflect that. Now, let's keep in mind, when I talk about bond prices falling, that means interest rates are going to go up, right? The value of a bond moves in the opposite direction of the interest rate. So in other words, if bond prices are tanking, which is what's about to happen, in my opinion, interest rates are going to skyrocket, which is what's already started. Okay, because that means that the bonds are becoming worth less and less, and the interest rate that you have to pay out as a result is going to go up and up and up. All right. So I'm going to basically summarize some of the things that were in this report and give you some graphics to go along with it. It's pretty interesting. All right. So what they said is, while they don't basically want to get into the back and forth as to whether or not the Fed's decisions in an economic panic during COVID were accurate, what they're doing right now is clearly a mistake. They're still actively inflating a bubble in bonds, stocks, real estate, et cetera, that will take a massive policy U-turn to stop. Okay. The net result of this binge purge is going to be a mess in the normal asset markets. So they also make an argument later on that the best place to avoid the fallout of this policy is in blockchain-based assets. It's a big surprise. Okay. So critically, the Fed missed the bit about at high rates. Their manipulation of treasuries, mortgage bonds, which still seems to be driven in some kind of trance, disconnected from reality, has driven rates to historic lows. But the party's about to end. There's never been a time in history, ever, with year-over-year inflation at 7.5%. And again, that's the number they quote you. My take, and I've said this many times, is that the real number is probably closer to 15%. And if you're in the wealthy end of the curve, it's probably more like 20 to 25%. But we've never had a time in history with year-over-year inflation at 7.5% and Fed funds rate at 0. Okay. If you discounted, or if you included rent and other things that the Fed excludes, you actually get a number closer to 9%. So this policy mix is clearly out of whack. It just doesn't make sense. Now, there's a lot of hand-wringing, as they say, over whether to raise rates 5 weeks from now, do it now as an emergency basis, create a schedule, publish the schedule. They should have raised rates 5 months ago. Actually, they should have raised rates this morning. Okay. But look, years ago, when I was back at Goldman, the Fed would act in real time. They wouldn't wait for all of this kind of nonsense to play itself out. There was none of this kind of forward guidance, as they're currently calling it. All right. So real rates, the interest rate one gets after inflation, are at a negative 5+%, which is a 50-year low. No rational person would buy something guaranteed to lose that much money every year. So in English, if I said to you, I'm going to basically ask you to put $1,000 into this account, and every year I'm going to take 5% out as your return. So you have less every year. That sounds like a great deal. Of course it doesn't. Right? So the Fed's manipulation of the treasury and mortgage bond market is so bad and so extreme that it's probably somewhere between 10 and $20 trillion overvalued, right? Relative to this, average rate over decades. So if you own any bonds and have yet to sell them to the Fed, of course, you might want to do so fairly quickly, because when their bond buying operation is shut down, we're going to have what Dan Moorhead at Pantera calls a Wile E. Coyote moment. And that's where the coyote goes off the cliff, plunges down the cliff, and lands face first in a big pile of rocks. So the bubble is about to burst. Since I talked about this back in December, right, 10-year notes are down 5 points. And rates are up 70 basis points. Guess what? It's just the beginning. This next mega trend has begun. What is the mega trend? Bond prices collapse, interest rates go through the roof. The first measure that the first measurable indication that this is happening is going to be new home sales, or existing home sales are going to plummet. And it's already happening. You probably saw the data this morning. In the United States, existing home sales are at a multi-month low. Market participants are still not grasping the scale of what's about to happen. Again, these 10-year rates are going to triple, at least triple, right? even if the Fed slows down the rate hikes and the tapering, right? They're still going to triple. So the question becomes, what is the impact of all of this on crypto? That's why we're all here. All right. So this is one of those times. Dan actually laid this out really well in his newsletter, and I'll put a link in Twitter so you can all take a look at the newsletter in detail. Because he's a reformed bond trader, worked in fixed income just like me, and so when you have a massive trade and you call that trade correctly, like in this case, the bursting of the bond bubble, which is happening in front of our eyes, right? Nobody predicted, or at least I didn't predict, and nor did he, an obvious side effect, maybe in hindsight, which is crypto prices getting crushed. So either we were both wrong about this big trade, right? Because I didn't predict crypto prices getting crushed, or at least temporarily, the markets have it wrong. And I don't make that claim very often. Usually the markets are right because the price is the price, whatever you're selling. It's not a question of opinion. It's a question of whatever somebody's willing to pay at any given time. So the first thing to recognize about the markets is it's one of those instances where in trading, you have a situation where you correctly call some huge disruption or change, right? Like this prediction that the bond market bubble is about to burst. But, right, sometimes you have a concurrent move in something that everyone at the same time said is driven by the first move that was predicted. Again, we didn't predict such a savage downturn in the price of crypto. So that puts us in this position of wondering whether they were wrong, that those things are connected, or that the market's wrong, and over time, it's going to shake out differently. So I personally have a very strong conviction that the markets are actually getting this wrong, and that the rise in interest rates, which has to happen, is not really that bad for crypto. As a matter of fact, it's not really bad at all for crypto, given the state of things. 21 million Bitcoin max, still the same number of Bitcoin. Ethereum is becoming deflationary, and the Fed still has their finger on the print button, even as they're talking about tapering. So I think all this nonsense is ultimately fantastic for blockchain-based crypto prices. So Joey Krug, who also works with Dan and Pantera, had a really good comment on this. He says, our macro view is that crypto definitely got hit by a lot of the news surrounding the interest rate hikes, but at this point, we think it's mostly been priced in. So as of today, the market's pricing in about 5 rate hikes, and a lot of that is being way overplayed in crypto. Ethereum went down to a low of about 2,200. And if you look at the 10-year treasury, it peaked at about 1.9%. And it's kind of leveled since then, right? So today it's trending at about 1.8%. Now that things have gone through this really aggressive move, right, where late last year, the 10-year was 1.3% and shot up to 1.9%, that was sort of a wake-up call to the market. But if you specifically look at crypto, when the traditional macro markets go down, crypto tends to be correlated with them for a period of roughly 70 days or so, a bit over 2 months, and then it begins to break the correlation, right? Now, I've talked about this a few times as well, where in extreme pullbacks, which have nothing to do with technicals, Bitcoin or crypto stock markets tend to become correlated for a short time, and then the correlation tends to fade, right? And this time seems to be no different. There's a couple of reasons for this. One, crypto is still a relatively small market. It feels big to those of us who've been in for a while because it's grown so much, but it's still small. And so things like the Fed funds rates being at 1.25% versus 0 shouldn't make much of a difference at all for something that's growing 4 times a year, year over year for a decade. Especially if you look at stuff like DeFi, which looks very cheap right now. DeFi assets have PE multiples of 10 to 40, But certain tech stocks, even after this pullback, are at multiples of 2 to 300. They were 4 to 500 back in January. Okay, so our view is it's going to decouple again over the next few weeks. Crypto will sort of trade independently again. And I agree with Joey that 2200 Ethereum was likely the bottom. Okay, so let's take a look at this one interesting trend right here that you see on this chart. Bitcoin deviation from its 11-year trend. If we look at the log chart for Bitcoin, and I've shown you this chart many times, it's the basis for my when in doubt zoom out commentary. Bitcoin is basically 60% off the trend. Okay, it's only spent about 12.5% of its entire history this far underneath the trend. Now, that doesn't guarantee it won't go down more, right? It's very possible that Bitcoin is 25,000. You know, a lot of this is just our interpretation of what we're seeing, right? We call it tea leaves or whatever. But the facts are the facts. It's spent 12.5% of its history this far into the trend. Most of its history has been on the trend. That's why it's called the trend. Okay. So look, the bottom line is that none of this is a guarantee. It doesn't guarantee that it won't go down a lot more, but it means that the odds are really high that the markets are at an extreme and will bounce back relatively quickly. In all of the years that I've been in this space, there's definitely been times when I personally sweated out, because even though I keep telling you I'm in for the long term, and I'd be lying if I didn't say otherwise. But I think, you know, I'm playing the odds, and the odds are in our favor, right? All right, so I'm quite bullish on this crypto market, and we think that prices are in a relatively inexpensive place. Thank you to our friends at Pantera for sharing that. Just a couple of other closing thoughts. Here is what a bond bubble looks like, right? So the forecast for the Treasury bond market cap, look at what's likely to happen when you're $15 trillion overvalued in what historically is a relatively efficient market. Tax day definitely has an impact on these markets. And the good news is that we're pretty close to tax day being done. Okay. All right. And again, on these year-over-year returns, you can see that we're way underneath the historical log chart. All right. And lastly, a similar perspective on the same, which overlays the four year-over-year returns, which are way below the norm. Right. So if you look historically, right, you're in somewhere around like 1,000% for year-over-year return model, and we're at about a 375% right now. Okay. All right. So I'm going to spend that's the bond markets as they relate to crypto. Hopefully that was interesting. Let me know in the comments and the show notes. On Facebook or YouTube or Twitter. Yeah. So one comment related to taxes. I know some of you are asking about CPERCs and the impact of CPERCs on taxes. We have published some articles at our FAQ around the value of CPERCs. The fair market value of CPERCs at the time of the airdrop was a fraction of a penny. And that has nothing to do with the trading price, because CPERCs wasn't highly liquid at that time. So you should go check out the FAQ articles on taxes. And I think you'll find that it's probably not as bad as you may be worrying about, and you may not actually have a tax bill related to CPERCs after all, if you're in the US. Okay. All right. So I want to talk about how these macro movements work over time as related to network effects. I saw a fantastic, what do you call a thread from this guy, Jurian Timmer, I think is how you say his name. Jurian, if I'm saying your name wrong, I apologize. He's an analyst for Fidelity, pretty well known in the macro world. Okay. And I'm going to show you the better parts of his analysis, right? So before I get there, one quick comment on this whole idea of being oversold. One of the indicators I track is this Rsi indicator. It's relative strength index, which you see here in blue. It kind of tells us in some ways when we're overbought or when we're oversold. Because when it's in this line here, that basically says we're in the middle of a trend. When you get to a trough or a peak, trough probably means there's a good, or potentially means there's a good chance we're oversold. Up here means there's a good chance we're overbought. We've historically never been this far oversold. You can go back out, a long time and see that it's pretty rare that we get into this kind of oversold territory. Doesn't mean we can't, sell off some more. But again, averages matter when you're basically making these mid and long-term bets. And I just thought it was an interesting data point. Okay, so let's talk about where we are in the macro cycle. So as I've said, I feel like, let me go back here. We're in this chop, right? So this is the Bitcoin chop going back about 9 months. All right. And we're bouncing between 30 and 65K, somewhere in that range. All right. So obviously the debate continues. And we don't know if this chop is noise. But ultimately, when it comes to Bitcoin and Ethereum as well, and maybe Solana, assets like that have, strong developer usage, real world use cases, it's the network that matters, right? And you've heard me talk about network effects many, many times. So here, let's start out with Bitcoin's demand curve. This is really what matters the most. Bitcoin's demand curve continues to be up and to the right. On this chart, we see that the number of Bitcoin addresses with a value of more than 0 continues to move higher, following a very simple power regression curve. All right. Nothing has changed on this curve. It continues unabated. So in the past, Jurian says he's compared Bitcoin's growth to historical S curves, namely mobile phone subscriptions and internet adoption itself. A more recent example of these network effects. So when you hear the term S curve, think network effect. A more recent example of a network effect is Apple's rise to network dominance in the 1990s. So let's take a little bit of creative license here and apply Metcalfe's law to the Apple scenario. Apple's network, crudely measured as its trailing sales, has increased 53x since 1996. Say that again. It's increased 53x since 1996. Its market value, on the other hand, has increased 1700x. Right. So that means that the value, all right, relative to something like Metcalfe's law or network effect, goes up faster, right, than the network effects themselves. So if Apple's increase in market value should have been roughly the square of its growth in sales, which is 53 to the power of 2, right? Because their trailing sales increased 53x. Then we get an expected growth rate of approximately 2,855x for Apple's market value. So it's 1,700x. It's kind of in the ballpark, and maybe it undershot the mark a little bit, but it's in the ballpark. Apple's price, right? So on the other hand, Apple's price has grown approximately 1,500x. You can see here, 1,457x since 1996, while its price to sales ratio has grown 30 times. Now, all of you in the back of your mind are saying, Bill, what the hell does this have to do with Bitcoin? And you're going to see in a moment exactly what this has to do with Bitcoin. And you're going to go, whoa, all right? If the growth in valuation is an exponent of the growth in sales, which is what Metcalfe's law describes, then price should increase as an exponent of both metrics. For Apple, that's exactly what's happened. So now let's compare this to Bitcoin's network growth and valuation. Here we show Bitcoin's price at the end of 2021 and its price to network ratio, which is kind of an attempt by Jurian to put a value on Bitcoin. Bitcoin's valuation has increased 867x since 2011, while its price has increased 640,000 times. If we apply Metcalfe's law and calculate the square of 867, guess what we get? 750,000. This is roughly in line with the 640,000 realized price gain. Amazing, right? All right, but now here is a side-by-side comparison of Apple and Bitcoin. Different animals to be sure, but they follow a simple path as dictated by the network growth. So what's next for Bitcoin's demand curve? How are its network effects likely to play out? Here are two possible scenarios that Jurien lays out that include two possible measures based on historical S-curves. Again, a way to track network effects. One is mobile phone subscriptions, and the other is internet adoption, exactly the models that we used earlier to compare to Apple. They show different slopes, but both suggest a similar overall long-term growth path. Both which, let's say we go out here to 5 years from now, 2027, on that growth path, and we're looking at a price of about 500,000 for Bitcoin. Again, I'm not telling you what the price of Bitcoin is going to be. I'm just telling you that history leaves clues. And if we compare the network effects of Apple and Bitcoin, and by the way, this works with Amazon as well. You can take Amazon and compare it to Apple. You can take Apple, compare it to Bitcoin, Amazon to Bitcoin. And historically, these S-curves line up. This tells us where we're headed. Now, obviously, there can be interruptions to these network effects, but they haven't happened in any sustained way over 10 years. Okay, all right. So I hope that was interesting for you. Much longer deep dive into the markets than we would normally do, but I think it was really, really important. And yeah, so we're going to get into a few other things here that I want to talk to you about. But let's see where we are. So we're going to get into this concept of proof of stake, how it works. And again, we're going to have Natalie on to talk about the Bitcoin analysis. But first, Abra is the easiest, safe, and secure platform to trade, borrow, and earn interest on crypto. In fact, you can earn interest on Abra just by holding your funds with us. Here's how. All right, welcome back. So last week we had a fabulous show with Nick Carter, who helped us understand how proof of work functions, how its energy usage and consumption works in relation to how Bitcoin are mined. Bitcoin and Ethereum, the largest cryptos by far, both run on proof of work today for validating and processing transactions. However, this is soon about to change for Ethereum. There are other projects like Solana, Cardano currently using proof of stake protocols. In June, Ethereum is scheduled to effectively migrate, a little bit more technical nuance to it than that, but effectively it's going to migrate to a proof of stake model. And by the way, I've seen some predictions that the staking rates for Ethereum are going to skyrocket as a result. But unlike proof of work, proof of stake doesn't require thousands of computers competing against each other to validate crypto transactions. Proof of stake is a method of allowing owners of crypto to stake their funds in exchange for the right to check for new transaction blocks and add them back to the chain, and then, of course, earn rewards in it. So in other words, if you stake some Ethereum to validate an Ethereum transaction, you get some free Ethereum for your troubles. That's what we mean by staking in this case. This makes proof-of-stake blockchains easier to scale and more energy efficient in theory. But let's take a look at how proof-of-stake actually works. So first, stakers or validators, and I've got a little graphic I'll bring up in a second here to show. Stakers or validators, sorry, I lost my track. Stakers or validators stake all or a portion of their coins to be eligible to validate transactions. Okay. Stakers are randomly chosen to validate a block, but these validators that have staked more coins or have coins that have staked longer are given an advantage, right? So in other words, the more you stake, the more potentially you can earn, because the more likely you are to participate in validating the next transaction. Okay. But these stakers are randomly chosen to validate a block, but these validators that have staked more coins or have coins that have staked longer are given an advantage, as I said. So when a block is ready to be staked, and we'll show you here this graphic showing what we mean here. Bring it up in a second. So when a block is ready to be created, selected validators must all agree in order to validate the transactions. So after the block is verified, it's added to the chain, and the miners receive a fee. The miners in this case are the validators. If a validator doesn't verify a block properly, they lose some or all of the coins they have staked. This provides a level of security and financial incentive against cheating or just sitting back and watching or trying to steal coins for that matter. So as you can see here, proof of stake differs significantly over proof of work chains like Bitcoin, right? The first area, of course, is energy usage. Proof of stake protocols mostly eliminate the need for thousands of computers all working on the same task by pre-assigning the computers doing the work. This uses a fraction of the electricity of proof of work networks. Now, Bitcoiners on the other side, of course, would make the claim that it's the security of the network itself that is driven by proof of work and the amount of electricity being used. But the two are trying to solve different problems. Ethereum as the world's computer and Bitcoin as kind of the sound money are actually trying to get at very different problem sets, even though there's a lot of overlap in the original technology. All right. So the next, of course, is this idea of security, where proof of work networks prevent attacks by requiring miners to expend computing resources in order to compete. If a group were to control more than 50% of the network's mining power, they could conceivably prevent transactions from being confirmed. They could double spend coins. They could initiate forks in the chain, making an alternate version of reality. Okay. Proof of stake disincentivizes malicious action from miners by requiring coins to be staked, basically creating a security deposit in case something goes wrong. It's kind of the simplest way to look at it. If someone were to double spend a coin on the network, the funds would be removed from their holdings in the system. So hopefully that makes sense. And the last part of the discussion on the nuances here is scalability. As proof of work networks grow, the need for computing resources and electricity obviously grows exponentially, which is exactly what we've seen with the hash power of Bitcoin. And eventually, it may no longer become feasible for miners to process transactions. I don't think that's going to happen because I think eventually, per our discussion with Nick last week, mining is going to move to basically be based inside of energy companies' facilities themselves. And they will determine when and how electricity gets used for the proof of work. But still, it is a massive commitment to have basically the global electricity grid facilitate the processing of Bitcoin transactions for the next 500 years. Right? Now, on the other hand, with the lower computational requirements, proof of stake networks, like what is about to happen with Ethereum, can grow more quickly and without these massive electricity needs of proof of work networks. So while it may sound win-win for proof of stake, there are definitely some drawbacks, right? So these validators with large holdings can have a disproportionate influence on validating transactions. Nobody's really sure how that's going to play out with Ethereum. Time will tell. I've seen some really interesting solutions to this problem. But there's definitely criticism that proof of stake is more centralized than proof of work. And I think a lot of that criticism is founded. But again, the two are trying to solve different problems. Some proof of stake coins require deposits to be held for a certain amount of time. Scalability advantage is only a theory at this point, because the only cryptos that have achieved significant scale, Bitcoin and Ethereum, both run on proof of work. Ethereum is planning to switch to proof of stake. And honestly, it is a risk. I'm super bullish on Ethereum. I've got over 50% of my crypto is now in Ethereum versus Bitcoin. And it's a risk I'm willing to take because I believe in the network. But to be clear, it is a risk. Okay, so that covers the basics of proof of stake. If you're interested in learning more, there's a ton of more detailed info on the web. Keep in mind, we're not that far off from the ultimate migration to proof of stake now. Abra is going to be launching full staking for Ethereum in the coming weeks. We're really excited about it. We'll have more to say on that. Don't want to give it all away now. But again, you can easily find more information on proof of stake online. If you want to swap back and forth between cryptos, Abra has made it unbelievably simple and safe. Take a look at how easy it is to trade on Abra.
Trading on Abra is easy. Just click the exchange button. Tap the source you'd like to trade. Tap on what you'd like to trade it for. Type in the amount. Then click trade. Tap, type, trade. Totally easy on Abra.
All right, welcome back. So our Bitcoin analyst, Natalie Brunell, is here with this week's deep dive into what's happening in the Bitcoin verse. Hey, Natalie, how's it going?
Hi, Bill. Thanks for having me. Well, let's go ahead and start with the biggest story in the world right now as it relates to Bitcoin, the Russia-Ukraine conflict. Now, Russian President Putin launched military operations in Ukraine that we are witnessing on social media, including distressing images of missiles and explosions. And the move prompted President Biden to issue more sanctions against Russia aimed at placing economic limitations on the country and adding severe costs on Russia's ability to conduct business. But the president stopped short of saying that Russia would be expelled from SWIFT, one of the most serious sanctions that can be placed on a country. Now, the SWIFT payment system, in case you're not familiar with it, allows for the transfers of money from bank to bank around the globe. Germany, Italy, Hungary, and Cyprus all blocked a decision to disconnect Russia from the SWIFT network. And you might be wondering, well, what does this have to do with crypto and Bitcoin? Well, it may have been possible for the US to remove a country from SWIFT as punishment in the past, but in the age of Bitcoin, there are some serious complications. A New York Times article was even published this week acknowledging something all of us Bitcoiners know. Russia could technically use Bitcoin to mitigate those US sanctions and blunt the force of being removed from something like SWIFT. It's precisely why some major voices in the Bitcoin space this week have been posing the question publicly of whether or when oil might be priced in Bitcoin. Russia could, in theory, subvert the SWIFT system by accepting payments in Bitcoin. And we also know the country has been working on its own central bank digital currency, the digital ruble. So the US right now has the power of SWIFT behind it because the dollar is the global reserve currency, but removing a nation from SWIFT in a Bitcoinized world could severely impact the US dollar's hegemony. Now, again, SWIFT sanctions, as of right now, they are not happening, but we will see if this changes. And in the meantime, I also want to mention that we've seen images of long lines at Ukrainian banks and ATMs running out of cash as people are trying to flee parts of Ukraine. Now, the images look very similar to what we saw recently in Canada and months ago in Afghanistan, as there was a run on banks to secure the money these financial institutions are holding. But I've also seen tweets of people sharing that they've been sending Bitcoin to people in Ukraine. They've been raising money in Bitcoin for the Ukrainian military. And obviously, this is one of the major value propositions of Bitcoin in these types of circumstances. Bitcoin's price might spike in volatility, but there's no run on a Bitcoin bank, and people can continue to both transact amid the unfolding chaos, as well as prevent their savings from being confiscated or frozen. Now, this is all obviously developing in real time, so I'm sure we will have more updates next week. But given all this, it's not surprising Bitcoin's price went tumbling to a 1-month low. It was about an 8% candle down as Putin ordered those military operations. But then later it spiked back up and gold actually fell. So Bitcoin's price will likely be very volatile in the coming days as this geopolitical conflict continues to take center stage. And I want to mention on-chain analyst Dylan LeClaire. He put out this great article in Bitcoin Magazine that I highly recommend, evaluating Bitcoin's price amid these world events as Bitcoin's price relates to other assets. What his charts showed was a strong inverse correlation between Bitcoin and the VIX, the S&P 500 volatility index, a strong correlation between Bitcoin and major tech stocks like Google and Amazon, all of which, by the way, demonstrating poor performance since last November, a strengthening dollar showing an inverse correlation with a selling off of Bitcoin. And interestingly, recently, a strong correlation between the Russian ruble and the price of Bitcoin, with the ruble weakening against the US dollar in tandem with Bitcoin's choppiness. Now, I mentioned on an earlier Money Talks that Bitcoin has shown a very strong correlation to the equities markets in recent years. It's been largely driven by liquidity and QE. And with the threat of tapering and rate hikes, many people expected Bitcoin's price to head for choppy sideways waters and tumble along with traditional markets. And that leads me to one of the big questions right now. There's a debate among Bitcoiners about whether the Fed will follow through on its plan to hike rates about 50 basis points next month. And you have some loud voices in the Bitcoin space saying, hey, that's off the table now, especially due to this conflict between Russia and Ukraine as the price of energy skyrockets. Max and Stacy, Pomp, and others are among the voices that are saying, hey, this absolutely will not happen. We are not going to see a rate hike. But others in the space, including Layered Money author Nick Batia, say rate hikes are still coming because the Fed has indicated it needs to act to fight 7% inflation. Perhaps they just might not be able to, say, hike the interest for very long. But given the world events, given commodities spiking, the cost of oil soaring, can they decelerate QE? I am personally of the belief they will continue to print, avoid the rate hikes, and apparently we will all know more soon because March is just 2 weeks away. So that's the latest on Bitcoin this week. Bill, back to you.
All right, thanks, Natalie. That was great, as always. All right, so as if Abra already didn't have enough ways for you to make money with us, right? We have something really cool for you here to show you today. So I want to tell you about a really great new program we've created for you. It's our Make Money with Abra referral program. It's an extension of our original Refer a Friend program, where you can earn $25 in crypto for everyone that signs up for Abra with your referral code. If you participate in the referral program, we will give you high quality personalized stickers that include your referral code embedded as a QR code. When you receive the stickers, stick them up for a chance to get rewards. You will get $25 in free crypto for each successful referral. Whoever scans your sticker to download the app and completes the program requirements will earn $40 in CPRX. Pretty awesome. Be advised, you should not deface public property or violate any city ordinances when putting up your stickers, of course. Here's how you can get your free stickers. So first, go into the app, click on the reward tier icon. It's the rocket ship on top of the screen. Then copy your referral code. Go to abra.com/sticker and paste your code, right? Type Go Abra, GOABRA, all lowercase, in the promo code field, then click apply. Then click proceed to check out. That's it. It'll take about a week to get your stickers in the mail. When you get your stickers and start putting them up, post pictures to your social media and tag us. We'd love to see where you place the stickers. A few things to note. We're going to ship the stickers for free for a limited time. And this program is only available in the US to start, but global customers shouldn't worry. We'll have offers for you soon. I'll take your questions next. Just as a quick reminder, please don't deface public property with your stickers. Have fun with it, but be smart. We're going to take a few questions up next. Before that, we're always coming up with new ways to make Abra a valuable part of your life. One of those is our CPRX rewards program. CPRX is the cryptocurrency we use here at Abra. And you and a friend can both get paid $25 in CPRX tokens when they sign up using your referral code. And here's how. All right, welcome back. I'm going to take a few questions and then call it a day. I see the whole bunch here coming in via YouTube, Twitter, Facebook, so pretty cool. No need to put your wallet ID in the chat. Just spamming everyone. No giveaways today. Questions on, I'm seeing CPerks and staking. The staking is basically done. We're just testing it with some last minute UX changes in Abra Earn, and that should go live pretty soon. So I know it's delayed versus what we originally told you, but we need to get it right. And I'm pretty sure we got it right. So stay tuned for CPerks staking. So not only stay tuned for CPerks staking, we're going to have a show mostly dedicated to CPerks next week. We're going to bring on folks from the Abra team and hopefully from the Crypto Banking Alliance and get into the future of CPerks and some of the things we're working on. So stay tuned for that. And so, yeah, a lot of comments on the growth of Money Talks. And people love Natalie, so that's great to hear. Appreciate that. We'll definitely get her that feedback. I don't know if Natalie's still watching. Yeah, so I think that, let's see, a lot of questions on XRP. You know, will we be adding XRP back into Abra in the US? Could be a big winner if they win their lawsuit. I agree. You know, right now we have to wait and see just because of the legal status. But you know, I certainly looks like XRP is kind of in a bullish trend right now, or could be very, very soon. Let's see. Michelle says, I got my stickers, very high quality. Thank you very much. That's great to hear. Let us know how you get on. Christopher also received his stickers. So that's awesome. People are already getting them. The sticker website, let me go back here. Somebody's asking me to read it again. So you go to abra.com/sticker, paste in your referral code, and then put GoAbra, GOABRA, in the promo code field in order to not have to pay the shipping. Okay, for now. So yeah, so Nikita, I am also very excited about CPerk staking. Somebody was asking me about the SEC's judgment for BlockFi and how it might impact Abra going forward. Right now, it doesn't. It's business as usual at Abra. We talk to regulators all the time. We're very comfortable with our approach and how we're doing things at Abra. Obviously, if anything changes, you know, we'll let you know, but your funds are very safe. I use Abra and Abra Earn exclusively as the place for managing all of my liquid crypto and cash, for that matter. It's all in Abra Earn. The team is very comfortable with our legal status, and like I said, you know, we pride ourselves on being very, very transparent here. So keep the questions coming, and obviously, you know, we have regular ongoing dialogues with myriad state and federal and global regulators, for that matter, and we'd be happy to continue answering your questions in that regard. So that's I think a few of you had that question. I think I saw that question at the end of the show last week and didn't get to it. So so there you go. I'll take two more. Actually, I'll take three more questions today. My voice is getting a little tired. I'm up in the mountains, so well, even though it looks like I'm on the moon. But let me see. Yeah, looking forward to the show on CPerks. Lots of questions on its long-term utility. I agree. So we'll get into that for sure. People, some really nice comments on the opening talk on bond markets and how it affects crypto prices and network effects. I'm glad you like that. I think it's really important. And I would also invite you, if there's anything you're going to share from Abra and video wise, I would really invite you to go back and share the video we just did on both bond markets and network effects as it relates to crypto, because it's really why I have such strong conviction from an investment perspective. And then I have my own convictions on where this is going from a technology perspective, but from an investment perspective, my conviction is very, very strong. Let's see. So I'll take two more questions, and let's see. Bitcoin will be worth 500,000 come fall 2023. I don't know. We'll see. Could be. You never know. Stranger things have happened. Let's see. Yeah, I've seen a lot of questions here, but I want to choose two questions that I think everybody is interested in. So what are your plans for new token listings, both in trade as well as earn? So I have a lot of those questions. I'll address them. We're going to be adding several new tokens to earn in the coming weeks, initially through for staking and also for CPerks. So stay tuned for that. Also, we have some new tokens that our custodian and Bittrex and others are allowing us to add to Abra Trade. And hopefully we'll see that in the next, I don't even know, but very, very soon, hopefully the next couple of weeks or sooner. So lots happening on the new token front. And then still getting more questions on taxes. Let me commit to saying we will include a segment specifically for US taxes on CPerks, which may help some of you in other countries as well, because we have some opinions on the fair market value during the airdrop and how to basically think about taxes. While we don't give direct tax advice, the information should be useful, and we'll include that during the show next week focused on CPRX. Okay. Yeah, so, and Nikita, we will also get into future use cases. All right, so I'm going to stop there. It's been a fantastic hour. Thank you for the questions, as always. I really love it. Getting users from all over the world, as always. Hopefully, we'll be in a state of peace by the time Money Talks airs next week. But in the meantime, I hope you all stay safe, have a fantastic weekend, and we'll see you on the interwebs. But in the meantime, have a great weekend, and peace, everyone. Take care.